Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, my name is Zhong and welcome to Through the Noise podcast. The US consumer inflation is probably the single biggest macro data for this week. Both headline and core inflation rose more than expected, raising doubts on the consensus first Fed rate cut by the end of Q2. Both equities and bonds fell on inflation print. To discuss that and more, I've invited Audrey Goh, our head of asset allocation, here at the Global Chief Investment Office. Hi Audrey. Let's address the elephant in the room. What are your thoughts on the latest US consumer inflation report?
The latest US inflation for March was certainly hotter than expected, and that followed yet another robust jobs report as well, which basically raised the risk of rates staying higher for longer. So given this, we see increased risk of the Fed delaying its first rate cut to the second half of the year instead of June. And if the first Fed rate cut is delayed, it would also likely reduce the chance of 3 rate cut this year, as the Fed has telegraphed, as they will be quite reluctant to make aggressive changes to policy rates ahead of the November presidential election. Now, if you look at ECB, them on the other hand has signaled an increased chance that it will initiate rate cuts this summer as inflation in this region has subsided. So based on these developments, we do see an opportunity to add to US inflation hedges, such as through the US energy equity sectors, as well as inflation-protected bonds. We will also look to add to US technology as well as communication sector equities on dips, given we expect these sectors to deliver strong Q1 earnings. And then within the bond space, European government and investment-grade bonds do look increasingly attractive, as we expect the ECB to start cutting rates as early as June this year. So on the back of that, we have also initiated some bearish Euro-related ideas.
You touched a little on bonds, and bond yields actually surged right after the hot inflation data. So what's next for developed market investment grade bonds after this sharp yield moves that we saw in the last week?
So the higher than expected inflation basically, fuel expectation that the Fed probably needs to maintain a tighter monetary policy for longer. So if you look at what markets are pricing now, they are anticipating less than 50 basis point of cuts this year versus Fed's own projection at about 75 basis point of cut. The change in this expectation has also driven more than a 25 basis point surge in the 10-year US government bond yield over the past week or so, with the 10-year real yield or net of inflation yield actually surging to a 20-week high of about 2.2%. Arguably, there are still some near-term upside risk to yield, but that being said, we do believe that the current level of US government bond yields present an attractive opportunity for investors seeking a core allocation to developed market investment-grade bonds. The US 10-year government bond yield now stands at almost 4.6%, and we will need to see another surge of maybe over 50 basis point in yield in order for investors to incur losses in DMIG government bonds. So that's quite interesting. And additionally, given expectations of sticky inflation as well as higher commodity prices, investors can also consider tactical positions in inflation-protected government bonds, such as TIPS, which can serve as an inflation hedge to their portfolio. And within DM government bond space, we are tactically overweight on euro-denominated bonds. The ECB concluded its April policy meeting by keeping their key interest rates on hold. However, President Lagarde has continued to deliver pretty dovish signal that a rate cut in June is plausible. So money markets are now pricing in an earlier rate cut by the ECB compared to the Fed. So as a result of that, this earlier as well as sharper ECB rate cut coming through, we do expect that to fuel the outperformance of euro-denominated bonds versus US bonds for now.
Since you start on the ECB, what does the later policy meeting mean for the euro?
Well, the ECB has kept their policy rates unchanged as expected, right? But they have basically signaled the possibility of rate cut by summer. And policymakers now is just awaiting for a few more comforting inflation as well as wage print before they implement a rate cut. And so this basically reaffirms our view that the ECB is likely to cut rates sometime in June, and the market is now pricing in a total of 75 basis point of cut for the whole of 2024. So to us, this is likely to act as a headwind for Euro US dollar, given that the Fed is also potentially being forced to hold rates for longer, given sticky inflation in the US. Therefore, if you look at interest rate differential, those are now more in favor of the greenback. So against that backdrop, we expect euro dollar to trade range bound with a pretty much a bearish bias over the coming weeks. And we also initiated bearish idea on Euro Kiwi as well as Euro Swissie.
Moving to equities, US Q1 earnings is set to begin in earnest tonight. So what are the expectations going into it?
So according to consensus estimates, the S&P 500 is expected to deliver around a 5% year-on-year earnings growth in the first quarter of this year. And this will be largely led by the communications as well as technology sector, which are expected to see over 20% increase in earnings growth this quarter. Energy as well as the material sectors, on the other hand, they are expected to see the largest earnings decline. But as always, what's more important is really forward guidance from company in terms of their forward-looking outlook. So for the entire FY 2024, consensus expect around 9.8% earnings growth for the US, and this has been shifted a bit lower from the 11% expected at the start of the year, as we've basically seen that given the strong 4Q 2023 earnings season, some of the growth have actually been put from 2024 into 2023. So if you look at both 2025 and 2026, for now, consensus are expecting 2025 earnings to grow about 14%. And our view is that for the US equities to continue to outperform, we probably need to see corporates sustaining the robust earnings expectations for this year as well as the next. So if you look at our preferred sectors, we continue to like technology as well as communication sectors. Those have done well year to date, but the Q1 expectations are also pretty high when it comes to their earnings. Even as we expect these two sectors to deliver the strongest Q1 earnings amongst the other sectors that we have. Energy is also another preferred sector of ours, and it has pretty low Q1 as well as 2024 earnings expectation. And with the oil prices now currently trading 10% higher than the 2023 averages, we pretty much see some upside risk in terms of energy sector earnings versus what consensus is expecting. So this is one key sector that we like as well.
Thank you for the insightful discussion, Audrey. To summarize it, the key takeaways for me are, firstly, the latest inflation report, I think, belies the Fed expectation that rebound inflation in January and Feb was a blip. Second is the developed markets investment grade government and corporate bond looks increasingly attractive after the recent sharp yield moves. And lastly, the robust earning growth for 2024 and 2025, they are key for the US equities. That's pretty much all the time we have for today. We'll speak again next week. Have a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.